Okay. Jackson, let's do it from the top. What's number one say up here?
In today's presentation general in nature? You bet.
Okay, two.
Are there multiple sets of rules that interact with each other and are nuanced and not straightforward? You bet they are.
Number three.
With that in mind, what is the goal today? And it is to introduce M1s, and that M1s result from accounting methods that are required for tax versus how income and expenses are recorded for financial statements.
And I think Chris said he had some inkling as to M1 item, or what an M1 is, and what it more of what it does. What's an M1?
So I can give you an example. So if a business depreciates assets on a straight line basis, but for tax purposes they use makers to reconcile taxable income to book income, we have to use an M1 to balance the balance sheet.
Okay. How do you feel about that, Jackson?
Makes sense.
Makes sense. Makes sense, Max? Sam, makes sense? It does?
I don't know.
There you go. There's only two answers, right? So I'm probably getting ahead of myself as usual. Well, let's take the guided tour and see where the hell it goes. Sam, what's number four say?
Let's start with a more fundamental question. What is an accounting method? An accounting method is a set of rules to record a transaction. Is there an accounting method that was utilized in the creation of the financials that are being utilized? The answer to that is yes. Does the IRS allow a taxpayer to use any accounting method in the preparation of a tax return? The answer to that is no. If you have a method used in preparation of financial statements and the IRS requires in certain instances a different accounting method, then there are differences in the accounting methods used for financial statements and tax returns. The difference in methods results in an M1.
Okay. So I think what Chris was saying, and correct me if I'm wrong, Chris, is that a company bought an asset for $10,000, correct? And in a straight line over 5 years, that's $2,000 a year of depreciation. Is that correct so far? Am I tracking with what you're saying, just putting numbers to it?
Yep.
Okay. That same asset, so this is GAAP. That same asset for tax has $10,000, but we have bonus depreciation. And I'm going to go back to the good old days where bonus depreciation was 100%, and I feel good about my math at that point. Okay? So for bonus depreciation, I have $2,000 a year, correct? For 5 years. 1, 2, 3, 4, 5, correct? Bonus depreciation, and then 0, 0, 0, and 0, correct? I've taken $10,000 of depreciation associated with that asset. So what this is saying is, well, is there an accounting method for book? What's the accounting method for book? It's taking the $2,000 a year depreciation on that asset. That is the method for book. Is there an accounting method for tax? Yes, there's an accounting method for tax. And due to our ability to take bonus depreciation in year one, we took all $10,000. Okay? So I'm going to pretend that we have $100,000 a year and for GAAP, we have $2,000 of depreciation, and we have $98,000 of GAAP income. So now we have to figure out, well, wait a minute. I have a tax accounting method, and I have a GAAP accounting method. Embedded in my $98,000 number is a GAAP accounting method for depreciation. So I'm going to do, you can do this one of two ways, okay? And I'm going to do it the long way for illustration purposes. I'm going to back out, take an M1 for GAAP depreciation, and I'm going to add back that $2,000 because I don't want it in that number anymore. I'm going to push aside the gap amount out of my tax calculation. And then I'm going to say M1 for tax depreciation. And that's going to be negative 10,000 because that's my depreciation number. My taxable income is $90,000 because I'm using a different accounting method for GAAP than I am for tax. But in year 2, this is year 1. Year 2, I have $100,000 of income, and I have $2,000 of depreciation, $98,000 of GAAP income. Chris, is that exactly the same as it was the year before?
Yep.
Yep. So now I have to follow the same procedure. I have to back out my GAAP tax, or my GAAP depreciation, $200,000. How much tax depreciation do I have, Chris? 0. So in year 2, I now have $100,000 of income. An M1 item is meant to calculate what the appropriate tax method of accounting is to arrive at taxable income. That's what an M1 is. Did I do a good job, Chris?
Yep.
Okay. Okay, who read last?
I did.
You did. Who you want to call on, Sam?
Allie.
Allie, what's number 5 say here?
What are examples of accounting methods? A, cash basis. B, accrual basis. Accrual method of accounting can be broken down into many subcategories. Deferred revenue, vacation accrual, accrued bonuses, bad debt deduction, depreciation and amortization for gain or loss on sale of asset, deferred compensation, non-qualified stock options,
ISOs. Yep.
Deferred compensation arrangements, reserves, inventory and warranty, and then change accounting 481A adjustments, and then C, permanent items, meals and entertainment and life insurance.
Okay, so the point of this is these are examples of possible M1 items where we're going to account for something for book differently than we will for tax. And I'm pretty sure we're going to go over some of these. Allie, who you want to call in?
Chris.
Chris, what's 6 say?
To understand the difference between the accounting methods, would it be a good idea to think about it from 2 different point of views? A, income recognition, and B, the ability to recognize an expense.
How do you feel about that? Would it be good to understand, to know how we recognize something for GAAP purposes and how for income purposes? In the category of income, would it be good to know how we recognize something for GAAP and how we recognize something for tax?
Yes.
Okay, so an example actually is, did we talk about installment method this morning?
Yes.
We did. Do you think that if a company sells something on the installment method, do you think GAAP recognizes the installment method, or does it recognize all the income in year 1?
I'm assuming year 1.
They recognize it all in year 1. Do we have the ability to defer that income for tax? We do, under the installment method. And how did you define installment method there, CV?
In chunks.
In chunks. We're going to give payments in chunks. Okay? So you have to be able to recognize, or Sam, diagnose what's going on by virtue of knowing installment sale rules exist for tax, but they don't for GAAP. And what about the ability to recognize expenses? Do you think there's differences there? There are. So for GAAP, an example of that would be, Jackson, earlier I put $10,000 into a bank account and said, it's yours because you rented the service, but you're not going to get it 5 years from now, until 5 years from now, right? Mm-hmm. And you said that that's not income to you today, correct?
Correct.
Do you think that's a GAAP expense?
Yeah. Yes, for
Yes.
you it would be, because you.
It would be a GAAP expense. So understanding that for GAAP, deferred comp that I put aside, it's Jackson's, but he can't get it for 5 years. He's not going to recognize that income for 5 years, but I'm going to take an expense for it. Now, if he's not going to recognize for gap expense, if he's not going to recognize it for 5 years, do you think the IRS is going to allow me to get a deduction for something I haven't paid him yet? The answer to that's no. So understanding the variance between how something is accounted for GAAP and the variance or the alternative accounting for tax is something that you should develop as a skill to spot when I have to have an M1. What's consistently treated as book and tax being equal and what's not consistent. And this list of items that Ali so eloquently ran through are opportunities to treat something differently for GAAP than it is for tax.
I would say lean on the auditors in the office as you work through that stuff, because you don't need to be an expert in GAAP by any means, but
I agree, yeah, 100%.
you need to know and understand how they're treating certain items before, you can make an assessment on anything new, so.
100%. So, an example of that, and tell me if I'm restating this correctly, Austin, is that if you need to know, there's a concept of deferred revenue. That probably would be a good example of what you're talking about. Deferred revenue for tax purposes, and there's actually an example in here, and we're going to talk about deferred revenue. Deferred revenue is, Jackson, I'm going to pay you $10,000, but you're going to do something for me over a 3-year period, a subscription something, okay? Well, on your balance sheet, I gave you $10,000 of cash, so you're going to debit cash, and you're going to credit deferred revenue, okay? So now, for GAAP purposes, they have to ask themselves, how much of that $10,000 am I going to recognize in the GAAP financial as earned? And to Austin's point, you have to understand how much they put into the P&L to figure out what you have to go back to this. I have to back out the GAAP number because I'm not going to utilize the GAAP accounting method, and then I'm going to add in the tax number or subtract or however that works to come up with that difference. So to Austin's point, you have to understand what is that GAAP number that I have to pull out. And I think you're saying, don't reinvent the wheel. Especially with gift cards, I hate deferred revenue. With all my soul, I hate deferred revenue, okay? Because of this complication, and when you buy and sell a business, deferred revenue is a ginormous pain in the butt, okay? So for tax, and we'll get there, is we get deferred, and I'm going to change to 9,000 because my math is going to be easier, Jackson. We're going to recognize that 9,000 over three years at $3,000 a year. What tax says, and we're going to talk about it, but this is worth knowing, the tax accounting for that says, hey, to the extent in year one the financials recognize that revenue, you have to recognize it for tax. Under that example, Jackson, how much revenue did you recognize for GAAP?
3,000.
3,000. So I have to recognize that for tax. Then it says you can defer the rest of it for a period of 1 year. So while for GAAP it's being recognized 3,000, 3,000, 3,000 year 1, 2, and 3, for tax it's 3,000 in year 1, 6,000 in year 2, and 0 in year 3. So that's a great example of you'd have to go to the auditor and say, okay, how are you recognizing this 9,000? 3,000 a year. And here's where the pain in the ass gets, is do you think you have deferred revenue 1 year? Or do you think you have it every year? Every year. So now you got a new layer of 9,000 the next year that you're recognizing 3,000, 3,000, 3,000. And now you have to go, well, for tax, for that layer, I have to recognize 3,000, defer 6, and now I have to combat what was happening the year before. And now you're reconciling what the hell is going on with the deferred revenue. Chris, did I say I hated deferred revenue?
Yes.
Do you now understand why I hate deferred revenue?
Yeah.
Yes. But it's something that we all have to confront and deal with. Do we not, Austin? Yeah. We do. Let's see. Chris, who you want to call in?
Carter.
Carter, what's 7 say?
What concept do you use to analyze income and expense recognition point of view? My favorite answer, it depends.
So this is the cosmic third answer that Austin brought up. It depends. And we'll demonstrate how it depends. Connor, what's 9 say?
How do you analyze a recognition of income and expenses for a cash basis taxpayer? For income tax purposes, the income and expense are recognized on the tax return when either cash is received or when cash is paid.
Okay.
How do you analyze the recognition of income and expenses for an accrual basis
Oh, no,
taxpayer?
no, we're going to stick on the other. Sorry.
Oh,
So stupid question, Carter. If you do business for me and charge $10,000 for that service, your GAAP financial is going to say how much money did you make?
10,000.
10,000. How much money did you receive? I haven't paid you yet.
0.
0. So cash basis accounting is a measurement of how much cash did I receive. So, and we're going to do this as a preview. This is a preview to something that we're going to do. But saying it out loud more than once, repetition is good or bad, Carter?
Good.
Good. Okay? So, stupid question. You said AR was 10,000, equity was 10,000, P&L 10,000. That's what you said, right? Is that correct so far?
Yep.
Yep, it is. Okay? So now it's this M1 item comes into play. Well, how much GAAP AR is in there?
10,000.
So I got to back that out, don't I? How much cash or tax did I receive? How much money did I receive? 0. So that's 0. So from a taxable income perspective, I got 0 taxable income. So this is the reason I'm doing this. I'm going to get us to year 2. I'm going to say, Connor, that you have now cash in year 2 of 10,000, AR of 20,000, equity of 30, P&L of 20. Does that math make sense to everybody? From a debits and credits standpoint, does that math make sense that I got a $20,000 P&L? It does? Okay. So now let's do our M1. The way this works for cash basis is you have a beginning AR amount. What's my beginning AR amount, Carter?
10,000.
10,000. What's my ending AR amount?
20,000.
20,000. So you have this fluxing or comparing the two. So 10 minus 20 is how much?
Minus 10.
Negative 10. My beginning P&L was 20. My M1, or my timing difference, because I have a different accounting method for tax than I do for GAAP, gives me negative 10, end at 10. So stupid question, Connor. How much cash is on that ending balance sheet?
10,000.
10,000. So you can see how this M1 allows you to say, this is how much cash I harvested, and that's how much I'm taxed on. Okay? Who you want to call in?
Connor B.
B or V?
V.
V. I heard B. I'm like, oh, I don't think that says M. Connor V. What's 9 say?
How do you analyze the recognition of income and expenses for a cash basis taxpayer? Number 10.
Come on.
We did 9. Number 10.
Yeah, 10. Sorry.
How do you analyze the recognition of income and expenses for an accrual basis taxpayer? In general, you use the all events test. This is terminology that you may want to explore. Try Googling. What is the all events test? This test primarily focuses on whether an accrued liability can be deducted on a tax return. There's a 3-pronged test. The first prong is all events have occurred to establish the ability. Second one is the ability can be determined with reasonable accuracy. And number three, economic performance has occurred.
Okay, just for the hell of it. Okay, all right. There is a lot. There is a lot in number 10. So let's, I don't know if I have this somewhere, but this is worth knowing. Okay? I'm just going to call it other for now. I don't have a better word. Okay? So, question 1, have all events occurred to establish the liability? Have I performed the service? Have you and I interacted with each other in a manner that sets that liability? Does anything else need to happen? That's a good way of saying it. Does anything else need to happen? If nothing else needs to happen, the all events test portion has been met. Can the liability be determined with reasonable accuracy? Generally, that's going to be true. The last point, though, economic performance. That's the trick. Okay? Economic performance in measuring whether you have a liability that you can accrue for tax purposes is the trick. Okay? And for goods and services, economic performance, and I'm quite confident now that I'm saying this is in here somewhere, and we'll go over it. And so the fact that we have a preview, I don't care, because Carter, repetition is good.
Good.
Right? So it's when delivered. It's that simple. When a good or service is delivered, then economic performance has been met. Okay? Then there's this other piece. And this other piece, I'm going to call, God, I wish, there's a series of them, and I'm going to give you some examples. Warranties, which I think is in here somewhere. Tort, which is a lawsuit. Games and prizes, and there's some other things, okay? So, economic performance in this other category only when paid. Economic performance for a good or service is, the economic performance is met when the good or service is delivered. With these other items, which include warranties and torts and some other things, and I'm sure it's in here somewhere, it's only when paid, okay? So why is that rule there, that economic performance for deductibility for tax exists only when paid? Why is that rule there? Well, let's call it the GE rule, okay? I'm pretty sure it was GE, actually. GE was sued for, I'm going to say, $30 million in 1960-something. Okay? So, stupid question. Were you the last person, Connor? Who was? CV, who you want to call in?
Sam.
Sam's writing. Let's leave Sam alone.
I'm ready.
Luke.
You ready?
I'm ready.
All right, Sam. Has GE been sued? Yes. Did they lose the lawsuit? Yes. Are they required to pay the amount? Yes. Does it feel like all events, everything that needs to occur, has everything that needs to occur has occurred to say GE has to pay?
Yes.
Yes. Can we determine the liability with reasonable accuracy? They owe $30 million.
Yes.
Yes. So if that's where we stopped, we just stopped right there, okay? That would be a deduction for GE, okay? And 30%, if their tax rate's 30%, that is $9 million of tax savings, correct? So if the only two things that existed was the first two prongs, GE could get a $30 million deduction, And that $30 million deduction saves them $9 million of tax. So GE now takes, in the other thing that I neglected to say was that this payment is made 10 years later, because there was some sort of payment stream associated with that $30 million lawsuit. So GE goes to our good friend Jim Belay down in LFS, gives Jim Belay this $9,000 or $9 million. Jim Belay gets him a 10% return, some number, and magically the tax savings that we did and we reinvested, we just used the government's money, invested it to pay off that liability. The government didn't like that. So they said, even though you have all events that have been met to secure the liability, you've been sued, you lost the suit, there's no way you're getting out of it, you owe the $30 million. The liability is determined with reasonable accuracy. We know what they owe. Well, you're not going to get the deduction until you pay it, because we're not going to let you use our money, the government's money, to invest that to pay off that liability. So economic performance, there are certain categories, and we're going to, I think, touch on them at some point in the middle of this, that economic performance is only going to occur when payment occurs on that. And warranty is one of those items. Sam, who you want to call in?
Max.
Does the IRS require to use cash basis or accrual basis methods of accounting? The IRS never mandates the taxpayer to use the cash basis method, but taxpayers with certain fact patterns are required to use the accrual method. Examples. Note some examples may not be 100% correct. Googling is a thing. One, C corps with past 3 years annual gross receipts of more than approximately 25 million, inflation adjusted. Two, partnership with a C corporation as a partner. Same gross receipts test. However, I believe that the test is applied at the C corporation partner level and not the partnership level. And then three, a taxpayer that carries inventory for sale to customers and has an average annual gross receipts of more than 25 million.
Okay, so let me ask a silly question, Max. If we have a taxpayer with an AR of $10 million, equity of $10 million, P&L of $10 million, and then this is year one of operations. Be a nice business. On the accrual method of accounting, assuming a 30% tax rate, how much tax do they owe?
About 300,000.
3 million.
3 million, sorry.
Yep, 3 million. Do they have any cash? They don't. So on the accrual method, they now owe $3 million of tax. Do you think they would prefer to be on the cash method?
Yes.
They would. Okay? So what the IRS says is fine. We understand that there's a disparity in between the timing of cash and being on a cash basis makes more sense. But they said, well, wait a minute, there's a category that we're not going to let you be on cash basis. And one is a C Corp with annual gross receipts of the prior 3 years of 25 million, a partnership that has a C Corp, and that C Corp partner has annual gross receipts of 25 million. And where that's a real pain in the ass is what happens when you have P1, which is owned by P2, which is owned by P3, which is owned by a C Corp. How the hell are you going to know at P1 through that chain that there's a C Corp involved? I hate it. So I just assume it doesn't exist. Somebody's going to have to tell me. Okay? But let's say that this is a nurse staffing company. Okay? And let's say that this is 30 million, 30 million, and 30 million, and our average gross receipts are, for the past 3 years, something more than 25. If this is an S corporation or partnership, can we be on the cash method?
Yes.
We can. If we're a C Corp, can we be on the cash method? No. Okay? So S Corps and partnerships have a different opportunity to be on cash method versus C Corp or a partnership with a C Corp, even though there's this annoying chain. Max, who you want to call on?
Carter.
Assuming no requirement to utilize the accrual method, can a taxpayer choose which accounting method? Yes, they can choose, but once chosen, they are required to ask permission to change the accounting method. When an accounting method is changed, the taxpayer is required to quantify all of the past items that have been reported and true them as if the taxpayer used that accounting method in the past. This is called a 481A adjustment.
Okay, let's stop there for a second. Okay, so Carter, you get called on a lot. And actually, I find that funny. It goes to you quite a bit. But the first class, there's this kid, or you guys know him, Jimmy Nicola. Okay? Jimmy forgot his bag and for the first night. And Jimmy went home and didn't stay for the fun activities. So the next day, I'd say, Max, we're going to interact. Max, who you want to call on? Jimmy. Jimmy, who you want to call on? Chris. Chris, who you want to call on? Jimmy. And it just kept pinging right back to Jimmy over and over and over. And I'm like, what the hell is going on here? Well, since Jimmy went home, they all conspired and said, no matter what, right, whoever it is in the class, we're all going to bounce this back to Jimmy. And I wouldn't say that you got the Jimmy factor, Carter, but it seems to come to you quite a bit.
I think it goes to Chris a lot. I think Chris has been the Jimmy.
You think so?
I do not want to be the Jimmy.
You don't want to be the Jimmy?
No.
But it was super funny. It didn't take me long to smoke out because it just kept bouncing right back to Jimmy. All right, stupid question though. If this is on cash basis, and this is our first year, how much taxable income have we reported? 0. Because our AR, zero beginning AR was 0, ending AR was 30. We get to back all that out, we reported 0. And for whatever reason, we decided that we wanted to change our accounting method. And we do a form, God, what's the form number? 3115. I'm ashamed I couldn't remember it. 3115 is the accounting method change form. And we say, hey, IRS, we want to go from the cash method of accounting to the accrual method of accounting. The IRS has 2 types of changes, or 2 types of categories to change. One is automatic, meaning you can just say, hey, I'm changing to it. And one is non-automatic, meaning they have to give approval. So there's 2 categories. Changing to the accrual method, from cash to accrual method, is an automatic change. So now you say, well, wait a minute. How much income, if I had been, Carter, on the accrual method, how much income would I have reported?
Pick up 30 mil.
I would have picked up 30 million. So they say your starting point, how much did you pick up as a cash basis taxpayer?
0.
0. How much would you have picked up as an accrual method taxpayer?
30 mil.
30. So this 481 adjustment that is being referenced here is comparing and contrasting what you did report to what you would have reported if you were on that method. So in this case, that was 30 million. And I'm going to change it now to 28 million because my math's easier. It's all about me. Let's just be, is that right? 28 million? It's 28, I think. What's 28 million divided by 4? I'm being a dumbass here. 7. That's what the number was in my head, but it just didn't feel right. Okay? So this 481A adjustment says that you're going to take that 28 million, divide it by 4, and we're going to allow you to bring in that variance between cash basis of 0 and accrual basis of 28, and you bring that in on a 481 adjustment over a 4-year period.
So you're not really picking up like the 30 mil. You're doing an adjustment for the 30 million over the course of 4 years to pick it up as income. So it's almost like an installment.
Yep. 100%. Okay, Carter, who you want to go to? Not Chris, evidently.
Jackson.
Sounds good. If you were advising a taxpayer in their initial year of operations, what are two very good initial questions you ask to assist in the determination of which method of accounting, which accrual on the balance sheet will be larger, one, accounts receivable, or two, accounts payable, and will the taxpayer have large amounts of deferred revenue?
Boy, what the hell does all that mean?
Not exactly sure.
Okay. Does that make sense to you, Austin? Why I'd be asking those questions?
Yeah.
Okay. I'm going to do 3 balance sheets. Okay. One is AR is 30, equity is 30. That's balance sheet 1. Balance sheet 2 is going to be AP 30, equity negative 30, 0, 0, 30, 30. Balance sheet 3, cash 30, deferred revenue 30, equity 0. P&L 0, P&L negative 30, P&L 30. Okay, 3 different balance sheets, 3 different fact patterns. And does that quantify accounts receivable, accounts payable, and deferred revenue, Jackson? It does. Okay, so Carter, going back to cash basis, how much income on balance sheet 1 would I be taxed on?
0.
0. Okay. Connor, on balance sheet 2, if I'm cash basis, have I paid the 30 of AP?
No.
No. So one of the things that would have been better for this example is if I said cash basis AR and cash basis AP are the same thing. Because I now have negative 30. I have a loss, a $30,000 loss, or $30 million loss, or whatever the number is, that's reflected on my P&L. And if I do the same thing, my beginning AP was 0, my ending AP was 30, I have a $30,000 add back that takes my P&L to 0. In the exact same way, it eliminates that deduction, in the same way it eliminates the income on the first balance sheet. Does that make sense to everybody? So, let me ask a question. Is it better, let's see, who was called on? Jackson. Is it better to report income you haven't received cash for, or wait till you receive the cash?
Usually you want to defer.
You want to defer
until later. So
100%. Okay. So for balance sheet 1, you would probably want to choose
the cash because
cash basis. So stupid question number 2. Is it better to take the deduction without paying it and get the benefit of it now?
Yes.
Yes. So for balance sheet number 2, you would want to be on?
The accrual.
You would want to be on the accrual. Balance sheet number 3, well, anybody, this might be gift card worthy, what was the rule for deferred revenue? Recognition.
When paid. Or, sorry.
When
That's
paid?
wrong. Sorry.
That is wrong. That's okay. Wrong is okay. It was the $9,000 deferred revenue, Max.
You recognize like what you were supposed to recognize in the first year on GAAP basis and the rest in the second year.
And Max gets a gift card. Oh, almost taking out Austin's eye. Okay? So, if we have $30 million in cash, we're on cash basis, do you suppose we're going to have to recognize all $30 million?
No, but you'll have to
Are
recognize.
you kidding?
In the first year?
Hold on, no, for cash basis.
Oh, cash basis, yes.
Yes.
Sorry, I thought we were.
So, on cash basis, we're required to report all $30 million. But on GAAP basis, how much are we required to, in GAAP financials reported 0.
So it'd be no.
None. Okay? So recognizing what you're dealing with and helping the client diagnose what method of accounting they want to be on is a real thing. Because I've seen clients that have deferred revenue and what are you doing? Why aren't we on accrual basis? Or the AP is outpacing the AR. Why aren't we on the accrual basis? If they're have lots more AR, why aren't we on cash basis? Let's see, who was the last person?
Me.
Who you want to call in?
Matt.
Okay. We should give the all events test a closer look.
Oh, see, I probably did this ahead. You got an advantage here, Matt.
The first two tests are generally met if an item of expense is accrued for financial reporting purposes, but the economic performance test is murky.
Go ahead. What's number 15?
What are the subcategories of economic performance? The economic performance test is met if goods have been delivered to a client or if services have been rendered, or the economic performance test is met if the accrued liability has been paid.
Does that sound like what we talked about?
A little bit.
A little bit? I'm being serious.
Yes.
Is everybody clear through repetition kind of what that kind of means? And were you my expert guy? Who was the expert guy? We're not here to be an expert.
Chris is the expert.
We're here to learn something.
Fire hose.
Fire hose? Sam's diagnosis. What were
Am
you?
I the expert guy?
I think you're the expert.
I'm the
guy.
expert guy.
Are we here to be experts?
Or you can be not experts.
The answer, we're not here to be experts, are we? We should?
Yeah, probably.
So, I mean, we're not here to be experts.
Yep.
I mean, we're here to recognize these concepts exist, and to the extent our ability allows us to harvest as much as we can, to develop a point of reference, to know it exists, to build more later. So what you take away from this is economic performance comes in two categories. One is if a good or service is rendered, then generally economic performance is met. There's another subcategory where payment's required. That's the thing that you need to know.